Well, in FinStreet today, we are talking about CV cycle and we have Mr. Digant Haria, founder of GreenEdge Wealth. Welcome to the show, Digant. To begin with, how do you see the CV or commercial vehicle cycle? Will this peak out in FY24? There are various analyst estimates which says that, CV cycle will grow at FY23 at the rate of around 40-45%, but it will taper down to 10% in FY24 and about 8% in FY25. So on the growth outlook, could you comment a bit, and how do you see the growth between pre-owned vehicle and new vehicle?
Yeah, thanks Abhishek for having me here. See, all the past CV cycles have not lasted for more than 2 or 2.5 years. And when there's a good cycle, we see a massive buying which happens, and then there is 2 to 3 years of bad cycle. See, it was all because in the last 10 years, the industrial sector, the mining sector, this whole infra-related activity was very slow. So this time, what is different is that apart from agri and the consumption economy, you also have the industrial and the mining economy, which is slated to do well. So I personally think that the CV cycle this time will last longer. But then in FY23, as you rightly said, we are going to build a very high base. On this base, we cannot grow at 20-30%, but I think a 10% growth for 2 or 3 more years should be good enough. We are not going to see a down cycle as severe as in the past. And yeah, between this, used and new vehicles. See, new vehicles are very expensive. They are large vehicles, high tonnage vehicles, and they are bought by the very strong fleet operators. I think both of them will do well. New CV will grow at 10%. Maybe the used CV part will also grow at similar rates because the others, the smaller transport operators, can do the used CV. So I see the cycle will soften, but it will still stay.
Okay, we'll speak about this price increase in new vehicles in my next question. However, coming on to the outlook, with the unorganized segment, how are they performing in the CV financing business? Also, the fact that, do they pose any threat to organized players? And of course, how do you see the competition in the market of CV financers?
Abhishek, see, in the new CV finance, actually, it's a very, very competitive market. So you have HDFC, ICICIs, and Sundarams of the world which fight in the new CV space. There's absolutely no room for any unorganized player to come here because the loan rates are 8, 9, 10%. So this market, absolutely no threat of competition. But then there is a used CV market, which is a very large market, but it is a very tough market to do business. You have seen how Shriram and Mahindras and Cholas took years to master that model. In this segment, Indostar has stopped lending. IIFL sold their business many years back. Magma is somewhat in the winding down mode. So actually, the competition in this segment is going down. Two small new players like Pokta and SK have come up, but they are very regional players, not big enough to impact the incumbents like Chola, Shriram, Sundaram, Mahindra. So I think good times for them are here to stay. They can cherry pick their growth. So I think anywhere between 10 to 15% growth is available for all the good players, especially in the used CV finance. New CV finance, we worry about banks all the time.
Well, you spoke about the cost of new vehicles. I know that cost of new vehicles has increased to as much as 40 lakh per vehicle. So, in your view, how much of the loan growth for CV finances roughly, has come in from the increase in vehicle prices or the tonnage increase which has caused the loan growth rather than the number of vehicles which have been financed?
I think see we're just about to cross the previous peak of 16, 17 in 23. So safe to assume that the entire growth has come out of the ticket size increase. See, because we went from BS2 to BS4, BS4 to BS6, so the price of vehicles have surely increased, but even the tonnage has increased. So when a 12 tonner used to be most common vehicle, then the average moved to 17. Now it's close to 22 tonners. So we are seeing that there's a big increase in the ticket size and the capacity of the vehicles, and which is why I said that in the new vehicles, it's only the organized large transporters who are buying these new vehicles because it's gone out of the reach of the smaller transporters. The smaller transporters are in turn buying 3 to 5 year used trucks from these large transporters, and that is where the big financing opportunity is. And that's where competition is also not there. So you're right that all the growth comes out of the tonnage and the ticket size. But in the used CV market, I think we will see that actual volume growth picking up.
Okay. As we know, it's a very competitive market out there. What impacts most the NBFCs or the lenders is the money, the cost of money that actually comes in. So cost of funds have risen for all the players and will continue to rise in the near term. As we know, we are in a rising interest rate scenario. Which CV Financer, according to you, has the most favorable borrowing mix, and which does not have a favorable borrowing mix in terms of, protecting their net interest margin as well as getting liabilities into their balance sheet?
See, I think Chola is the only one who has some sort of an ALM mismatch on their balance sheet because they have a very large bank borrowings. And see, CV loans are fixed rate loans, so I can't increase the rates for my customers, but the banks are going to charge me higher for borrowings. So I think Chola is the only one who's going to take some margin hit for the next 2, 3, or 4 quarters. Beyond that, see, Chola can also pass on the increase in borrowing rates to their customers, but they will still have to bear some bit of pressure in the next 2 or 3 quarters. I think Shriram, Sundaram, and Mahindra Finance, these three have a reasonably large proportion coming out of bonds, which are fixed rate instruments, and on the lending side, they have fixed rate loans. So they are, I think, quite well placed. It's only Chola who has a slight, 2 or 3 quarters of margin pressure, which is going to hit them. And see, Abhishek, more than the borrowing cost, I think these companies will be able to pass on the increased borrowing cost because the freight utilizations are good. The people are getting 4 trips a month, which is, a slight improvement from what we saw before pre-COVID times also. So I think the cash flows of truckers will be good.
Well, that's the word coming in from Digant Haria of GreenEdge Wealth, speaking to us, saying that, Chola will have some rise in cost of funds more than, what the other players are seeing. Thanks for joining us, Digant Haria, and look forward to you, on the show again soon.
Thank you for having me.